Good afternoon, everybody. It's Thursday, July 28th, and it was a huge week in terms of earnings and a lot of data, but there's two really key things I'm going to talk about today. First is the Fed's meeting yesterday, and second is the number that we saw about the GDP from the Commerce Department today. Let's start with the Fed. So the Fed, for the second time in 2 months, increased their key rate by 75 basis points, by 0.75%. They did it in June, did it again here in July. Their new target rate is about 2.25% to 2.5%. This was totally expected. The markets had basically placed about an 80% probability that the Federal Reserve is going to raise by 75 basis points. That's what they delivered. I do think that Chairman Powell has done a pretty good job of projecting out there to the financial markets what the Fed's intentions are, both now and moving forward. And I think that's a good thing. The markets don't like uncertainty. They didn't get uncertainty yesterday. They got exactly what they expected, and the markets responded pretty well to that. The NASDAQ rallied by about 4%, S&P rallied by a couple percent, Dow rallied by about 1.2%. So it was a pretty good broad-based rally, no real surprises. And Powell also had mentioned that now they've got a little bit of room. So in the future, they can either stop increasing interest rates or even maybe reduce rates if economic necessities demand that. So let's talk about those economic necessities right now. So we got a key number today. The Commerce Department came out and they said that GDP, gross domestic product, that is the amount of real activity, goods and services generated in the economy, shrank in the second quarter by almost 1%, by about 0.9%. That is on the heels of a 1.6% decline in the first quarter. What that means is we've got 2 quarters of back-to-back GDP contraction. Up until 5 minutes ago, that meant we were in a recession. I do think it's pretty staggering. I'm watching some of the financial press today, and depending on who you're listening to, we are either now in a recession or it's more nuanced than that. I don't believe it's nuanced. We had 2 quarters of GDP contraction. I'm going to operate on the assumption that we are in a recession. That's always been the definition. Again, up until about 5 minutes ago, you have Yellen coming out and saying, well, the labor market's really strong. I would add to that, though, that we still have about 500,000 people less that are working than we did before the COVID shutdown in March of 2020. So in February 2020, there was more people working in this economy than there are today. So that doesn't really hold the water with me. You have the Biden administration, the White House put something up on their website on Monday basically saying, well, it's more nuanced. What is a recession? What isn't a recession? I'm going under the assumption 2 quarters of GDP contraction, we're in a recession. So what does this mean in terms of the markets? Well, back on May 27th, I was asked the question, what if we have a recession this year? My answer back then was, I think we're already in a recession. The reason I thought that 2 months ago was not because I'm that brilliant or because I've got some crystal ball. It was because that was what the markets were saying. In the past, usually what you see is you see equity markets specifically start to go down 6 or 7 months before you're officially in a recession, before you officially get those 2 quarters of GDP contraction. Most major markets hit their high on January 4th. For the most part, we've been going down since then. We hit deeper lows than we are right now. Back in June, the markets had a little bit of a rally since then. But basically, the market's been going down for about 7 months or so since January 4th. That's pretty typical. What has also happened in the past is if you're in a recession, usually you see about a 30% decline in stocks. And what we've seen at the worst of it in the middle of June, you had the S&P 500 down about 25%, you had the NASDAQ down about 35%. You can kind of do the math there. It looks pretty typical of what we've seen in the past. Now, the positive news is once it's announced we are in a recession, normally all the damage is done. Normally all the declines are kind of cooked in at that point, and then the market starts to build a base again before the next leg higher. Can't guarantee that's what's going to happen in the future, but in the past, that is what has occurred. I think we possibly could revisit the lows that we had in June, which is down, 8-9% from here anyway. If we get down there, I think it's kind of a quick hit. I don't know that we necessarily stay down there, but everything that the market is doing, what the market's kind of telling us is that, yeah, we're actually in a recession, despite the, quote, more nuance, I guess, that people are demanding now. But probably a lot of the damage has been done. So both of the big data points in terms of the Fed, in terms of GDP numbers that came out this week, they were kind of what I think the market overall expected. It's for sure, it's at least what I expected. And I think at this point now, I think, hopefully we see these markets stabilize a little bit, build a base out here, which could take a little bit of time. before things begin to improve, not only for the financial markets but in the economy overall. But you've got a lot of things. You've got midterm elections, which a midterm election year tends to be a little bit more volatile, and we probably won't get a lot of resolution until that occurs. But in the meantime, we kind of a lot of data today. We talked about the Fed. We talked about, are we in a recession or not? I'm saying yes, I believe that we are, and I think the markets have reflected that. But if you disagree with me, give me a call. I would love to continue to hash out some of these ideas. If you have any questions that you have for me, please reach out to me or a member of my team. And as always, if you stayed with me now for 5.5 minutes, I really appreciate it. And I look forward to the next one. Take care.